concepts of how that works. I've got to have an understanding of that in order to understand basically who's the taxpayer. That's a critical thing for me to understand from the beginning of the year. It might make the difference between whether I'm buying corporate bonds or municipal bonds, for instance. The trust in general is going to be a very high bracket taxpayer, whereas the beneficiary might not be in such a high tax bracket. And so it's a critical thing for me to understand, not just at the end of the year when I'm doing the tax return, but at the beginning of the year when I'm trying to choose what investments are appropriate given the trust and the expectations of distributions for the year. Mandatory distribution language should also be redetermined every year. Sometimes it changes based on age attainment. So I might have a fully discretionary trust, says distribute so much or all of the income and or principal as the trustee deems appropriate. And yet at the age of 30, Daniel gets $1 million from the trust, or gets 25% of the value of the trust in that year. And so in those mandatory distribution years, depending on how the wording of that language is, that's going to carry out the taxation of the year out to me, out to the beneficiary. So have proactive discussions, certainly, about anticipated requests for distributions. This is a critical thing for the trustee to engage in on an annual basis with the beneficiaries, thinking about and anticipating what's going to happen over the course of the year. Again, not being reactive, but truly understanding these principles and being proactive in our conversations with them. And explain the purpose of that. Well, why do we need to understand that? Because we're trying to serve you, save you money, invest in the proper way for the beneficiaries, and that changes the taxation of how those elements work. And again, document those factors at least annually. Anytime there's changes inside, annually is the standard process that we go through to document discretionary decision-making inside of a trust. So we mentioned the tie-in here from property law and principal and income law into fiduciary income taxation and how it breaks up how the trust gets taxed. Again, the concept is the trust or estate pays, which is simply a way of saying that they are the default taxpayer. And then the exception to that is unless the burden is shifted to the beneficiary through distributions from the trust. So anytime you have an irrevocable trust, you have two potential taxpayers, either the entity or the beneficiary, to the extent distributions are made in that year. Of course, taxation would only follow those distributions to the extent of taxable income in the trust. So there's a complicated little formula they go through and a little concept we call DNI, distributable net income, that sort of shows the apportionment of taxation out to the beneficiaries in a given year. There's, of course, an exception to that as well, which is the grantor trust rules. So grantor trust rules, where you ignore all this stuff completely, and you basically just say the trust will be an unconsidered actor in this process. It may be collecting the income in, but it's going to distribute everything out to the beneficiaries. The beneficiaries are the ones who are paying the tax on that. So yes, this is all assuming irrevocable trusts. As I said early on, all of this process deals with the irrevocable trust side, unless we identify otherwise, right? Revocable trusts are simply flow-throughs. They're always grantor trusts for tax purposes. And so irrevocable trusts are the way we tax. Now, all revocable trusts are grantor trusts. So they are all those windows of consideration go out. The secondary beneficiaries, honestly, go out, right? Basically, a revocable trust is like a investment management account, right, with all the bells and whistles put in place, should the client become incapacitated, when they pass away, that it becomes irrevocable. So also in fiduciary income taxation, the beneficiary's income has the same character in the hands of the beneficiary as in the hands of the estate or trust. That's important to understand with so many see-through types devices like IRAs or things like that, where every dollar that I earn that is taxable income that goes into that traditional type of plan, it doesn't matter what it was inside there. It doesn't matter if it was capital gains or qualified dividends or anything else. When it comes out as ordinary income, because that was ordinary income that I'm sheltering going in. It's a deferred compensation type of plan. So naturally, it's going to be ordinary income when it's coming out. But that's not the case with a trust, right? A trust is simply a taxpayer. And so it can have tax-exempt income. It can have qualified dividends. It can have long-term capital gain treatment. And so the treatment of that income treated as distributed through the beneficiaries maintains that same character. That'll show up on their K1 reporting device that comes out to the beneficiary, showing them what is going on. So again, I want to document our consideration of that process on an annual basis, just to demonstrate that we're considering the tax consequences to the trust for that year and each of the beneficiaries. One of the things that some people don't also think about is the transfer tax efficiency of the different arrangements, right? Not all arrangements are treated the same. So assume I pass away over here. I had, let's say, a revocable living trust, and it creates some irrevocable trust as a result, maybe a bypass type of trust, and maybe a marital trust over here, and then I have my surviving spouse over here. So very, very important for us to consider the fact that when I pass away, money goes into that bypass trust, money perhaps goes over into that marital trust. Some of it's includable in my surviving spouse's estate. Some of it is not includable in my surviving spouse's estate. And that creates an asset location decision that becomes very, very important. If in a typical instance like this, we have the surviving spouse with their own money. We have a marital trust for benefit of the surviving spouse and eventually for the kids. We have the bypass trust for benefit of the surviving spouse and eventually for the kids. You basically have three accounts that are essentially supporting in exactly the same way the same people. And so we want to think about, from an asset allocation standpoint, not each account individually necessarily, but take into account the big picture. Identify all of the potential issues that are associated with this trust and do an asset allocation model associated with that. And then within that, say, now from an asset location standpoint, how would I want that asset allocation spread around through those similar accounts? Obviously, those accounts can be very different too. They have different sets of beneficiaries, and that might change the mindset. But very, very often, these are within nuclear families, taking care of surviving spouse, leaving things to common children. And so you have very similar objectives in each of the three accounts, and we can really play a substantial game there, not just from an estate tax standpoint, of course, but also from a generation skipping transfer tax standpoint, thinking about which accounts are protected and which ones are not, and in what order, generally speaking, we should take distributions and where we should have our growth versus income, right? In general, I'm going to bias towards growth on this side because these assets grow right now from about $12 million. Average life expectancy of a surviving spouse after the first spouse passes away, about 8 years. So Rule 72 at a 7% rate of return, that's almost a doubling of the assets. Let's say we go from 12 to 20 million. This is going to pass down completely estate tax free. Well, that's certainly not the case on the other side of the ledger, where these assets are includable in the surviving spouse's estate. And so over here, I'm going to bias myself towards the income side. Again, none of those say that I'm going to invest in that way. It's just that that's my initial bias in those trusts because of the way the transfer tax structure is created around estate taxation, around generation skipping transfer taxation. Very, very important to consider the transfer tax results, not just the income tax results. Again, I want to reiterate whether there have been any changes. Generally speaking, those structural changes don't alter from year to year. And so it's important to consider that on a regular basis, but it is not something that's going to change on a regular basis in most types of accounts until another major change takes place. Surviving spouse passes away, for instance, or if one of the kids passed away, or something changed to alter the wealth of the family in a manner that altered the objectives associated with the account. So within the Uniform Prudent Investor Act, of course, there's a lot of information about prudent investing. Most relates to the typical things that we talk about from an investment management standpoint. Let's not trouble ourselves with those here. We want to focus on the things that are uniquely oriented to the trust area. So naturally, it says that we should invest and manage the assets as any prudent investor would in the light of the purposes, terms, distribution requirements, and other circumstances of the trust. I always found that phrase to be kind of appealing to say, oh, that's new. What other circumstances are we talking about? And naturally, it goes through a whole list of things that are normally investment related. We'll talk about those on the next page, but it's something I want to dig down into because there's a couple of those that can be uniquely applied in the trust world, and I think they're worth looking at. Naturally, diversifying the assets is an important aspect of that. Very much so, the Uniform Prudent Investor Act is built around concepts like modern portfolio theory, and diversification is a critical element associated with the account. But it's diversifying assets unless it is prudent not to do so. Again, in many cases, I might have a trust whose specific purpose is to hold my company stock, which is a closely held family stock. It looks like a concentration when I look at that trust by itself. But if that's the purpose of the trust, then it's understandable why I have such a concentration. And I will also want to buffer that concentration by looking at the wealth outside of that trust, the rest of the estate plan, the other assets, the beneficiaries, et cetera. That's a critical aspect of that. There's no automatic rule or percentage for identifying what diversification is. In a typical trust company, I'll find that the safety rails are somewhere around 10%. You can't have more than 10% in any particular type of security other than something like government bonds without having documentation in the file. It doesn't mean that 9% is safe and that 11% is risky. It just means at some point you got to say, at what point do we err outside of our policies and procedures range, and I should be justifying why that concentration exists inside of the account. Again, I'm not saying it's not unjustifiable. It's critical to understand. I could have 25%, 50%, 70%, 100% of the account in a single security, but I should be explaining why, and I should be reiterating that that still stands on at least an annual basis. The reason why I'm going back to all this stuff is we're kind of preparing for the worst. If 70% of the lawsuits are against trust or investment related, I want to make sure that should a lawsuit ever come, I have pre-thought about and papered my files appropriately to explain why I've done what I've done, which is the only thing that a judge should ever look at. It's not outcome based. It's process-based. We're looking at the process that we're going through, and so we're just trying to identify each of the key components that should be in that process. So the fact that the trustee does not diversify is not per se negligence. The circumstances dictate whether the fiduciary is acting prudently. Duty to diversify may exist despite specific language inside of the trust document. Sometimes trust documents tell us to do things that we just shouldn't do. As a practical matter, there's sometimes outdated advice. It will say, never sell this security, right? Which maybe has done fantastic for the client over time. But those kinds of instructions over time become problematic. Lots and lots and lots of lawsuits. Kodak is the classic one as a subject of some of those lawsuits, a company that just didn't keep up with changing times. And so even though family members who had generations of success in a company like that, there came a time when it should be appropriate to diversify. And if the fiduciary is at all concerned about diversifying, especially in light of the language of the document, going to the courts and getting guidance on that is appropriate. Again, it doesn't have to be a contentious dispute. It's simply getting guidance. Court, the document tells us not to diversify. We find that to be fundamentally problematic, but we understand what the initial purpose was. However, we believe there's been a change in circumstances over the generations as the economy's changed, as companies have changed, as industry has changed, whatever it happens to be that you're arguing about. It's really, really important to get that out on the table, and that would be a good CYA memo to have in the file, essentially, that you're explaining to the court why you're doing what they're doing and getting the blessings of the court. Do you agree that it is appropriate at this point that we depart from the strict language of the document itself? I saw several trust documents, for instance, written a long, long time ago that said the trustee may only invest in high-quality railroad bonds, which may be an oxymoron. I'm not sure. So from a fundamental standpoint, I understood why those were when you looked at the timing of that. In fact, if you look at a monopoly board, right, you'll notice that 4 of the highest income stops on the monopoly board are the railroads, the 4 railroads that are on there. It was a go-go industry back in the day, and I could understand why people felt that was a place to be. Safety, security, huge cash flow that was coming out of those arrangements. But is it still today? That same industry that was described in those original arrangements. And again, judges will make decisions in different ways. As I recall, the decision in one case was, yes, you're right, the economy has changed completely, investing has changed completely, you are free to do anything you want to in modern portfolio theory. In the other case, the judge similarly kind of dismissed the instructions, but it does say fixed income. And so even though I'm going to allow you to invest in any kinds of bonds, not just high quality railroad bonds, I would prefer you lean towards high quality, and they should be bonds. They should be fixed income because that